Hi everyone, welcome back to my channel. I'm Surbhi Gupta and we are reading economics topics from Tamil Nadu board book. But as I always say in every video that the book doesn't matter, but the concepts that we are doing are of really good importance. So let's just quickly start today's topic and I'll share the screen. So just give me a moment. We are going to begin with the product method today. And what is the product method? In the previous class, we could understand that what are the different methods of measuring national income. And today we are starting from the separate methods. And the first method that we are going to do today is product method. So what is product method? Product method is a method that measures the output of the country, and it is also called inventory method. So as I told you that there are stages when the product is formed. A product is being formed with the help of factors of production, which is land, labor, capital, and enterprise. And when the product is formed, then the wages, the product's price is being decided at the factory price, at the price that the product is being made, given when you give the wages and the factor payments. So on that basis, we measure or we find the value of the product. So you have a value of a product, say 100 rupees, after paying 25 wages, 30 rent and whatever, so on and so forth. So you made factor payments. Okay. You did factor payments, that is factors income. So that goes as income method. So now once the factors have the income of say 100 rupees, they go onto the market and purchase their basic needs, spend those 100 rupees. That is the expenditure method. So this is what's happening, and these are the factor prices when they go into the market. We call it market prices when there are taxes, when minus subsidies, when we do all of it, and what is the final price at which the consumer is getting that product is known as market price. Okay, so these are the differences. So what is product method? Product method measures the output of the country. It is also called inventory method. Under this method, gross value of output from different sectors is taken. So we take sectoral contribution, that the gross value added by each sector, say agriculture sector, say trade sector, say industry sector. What each sector is adding value, we take it into the account. Okay, and when we add it for the entire economy, we get GNP at market price, gross national product at market price. Okay, care must be taken to avoid double counting so that we don't double count a value of any of the products. All right, so the value of the final product is derived by summation of all the values added in the productive processes. To avoid double counting, either the value of the final output should be taken, okay, that what is the final output, the estimate of GNP, or the sum of values should be taken. So either the final value of the product should be taken or the value added at each stage should be taken, not both, because then it would lead to double counting. So in India, the gross value of the farm output. How do we add the gross value of the farm output? So that is what is being shown. Total production of 64 agriculture commodities estimated. That how much these 64 commodities, agriculture commodities, have produced in total. The total production is taken into account. The output of each crop is measured by multiplying the area sown by average yield. So area, itna area, the area in which that particular crop is being sown into the yield. That is the total production of that particular commodity, and similarly 64 agriculture commodities are being taken. The total output of each commodity is valued at market price. The aggregate value of total output of these 64 commodities is taken into to measure gross value of agricultural output. The net value of the agricultural output is measured by making deductions for the cost of seed, manure, and fertilizer, market changes, repairs, and depreciation. So we reduce the depreciation and the input cost to get the final value or the value of output. Okay. Similarly, the gross values of the output of animal husbandry, forestry, fishery, mining, factory establishment are obtained by multiplying their estimate total production with the market prices. So it is like total quantity into prices. Total quantity, that is the output produced, total production into prices, that is the market price, okay, of every sector. And then finally the value added, the total value added by each sector is taken into account and unka sum ho jata hai, they are added to get the GNP at market price. Okay, net value of each sector measured in this way. So we get GNP में से gross है, हम depreciation minus कर देते हैं, we get net value. Okay, this is the net sector contribution, like agricultural sector contribution into the national income, industry contribution into the national income. This is how we take. But there are some precautions that we need to take care of. The product method is followed in underdeveloped countries. So in underdeveloped countries, we follow the measure or the method of product method to measure national income, but it is less reliable. Why? Because the margin of error in this method is large. In India, this method is applied to agriculture. So in which sectors this method is applied in India? Agriculture, mining, manufacturing, including handicrafts. Okay, double counting is to be avoided under value added method. Any commodity which is either raw material or intermediate good for the final production should not be included. Okay, for example, value of cotton enters. So if we take a t-shirt, so we should take the final value of the t-shirt, and then the cotton, the yarn, and every other cost of the inputs is already included into the value of the final t-shirt that is being produced. Okay, so that is the case. It is to avoid double counting. The value of output used for self-consumption should be counted while measuring the national income. So if you are producing something for your own self-consumption, it should be counted while estimating the national income. In the case of durable goods, sale and purchase of second-hand goods, for example, pre-owned cars should not be included because the sale and purchase of that car has already been included in the previous year's national income. So the resale or repurchase basically should of the second-hand goods should not be included because they were produced once. So if any good is produced, their value have been added into the national income of previous year once. So you should not include it twice or thrice because nothing has been reproduced. It's just being resold, okay, or repurchased. So that is the case. And with that, we have come to an end of this method, and tomorrow we'll begin with the income method. I hope you liked it. Any queries, any questions, shoot it in the comment box and I would be happy to answer. Share your feedback. How are you liking these videos? And thank you so much for already pouring in a lot of good feedback. So thanks a lot, and I'll see you tomorrow with another one. Till then, take care, guys. Keep practicing, stay healthy.